If you glanced at the recent headlines for AST SpaceMobile, you'd swear this company was circling the drain. The stock cratered 17% in a single brutal session, touching an intraday panic low of $53.33, right after management dropped a bombshell $1 billion convertible debt offering. Retail investors slammed the sell button. Even some institutions bailed, dumping shares in a frenzy over dilution fears. And that's exactly why so many investors panicked over completely the wrong news. Because here's the thing they missed. Wall Street is largely ignoring a quiet, surgically strategic $96.9 million insurance policy that management purchased behind the scenes. Over the next few minutes, we're going to unpack why the market's knee-jerk reaction might be dead wrong, why insiders are dumping while giants like BlackRock keep buying, and why the path of maximum pain for this stock right now might actually be straight up. If you find this kind of deep breakdown valuable, do me a quick favor and hit that like button and subscribe. It genuinely helps this channel more than you know. Now, let's get into it. But before you get too bullish, there's another layer to this, and we need to understand exactly how we got here. Just a few months ago, back in May of 2026, ASTS was the undisputed darling of the entire space sector. It surged 59% to an all-time high of $133.86. Investors were euphoric, and then the floor gave way. Since that peak, the stock has suffered a savage 60% drawdown, recently closing at $57.80. Part of that was just the broader sector cooling off. But the real bloodbath began on July 15th. That's the day the company priced their $1 billion in convertible senior notes due in 2034. The initial conversion price was set at $79.57, which was a healthy 20% premium to the stock's price before the announcement. But the sheer size of that headline number, combined with commercial launch targets getting pushed back to early 2027, triggered a wave of pure selling exhaustion. Now that sounds incredibly bleak, doesn't it? At least until you look at what's actually happening underneath the structure of this deal. Because what if the very thing everyone panicked about was secretly engineered to protect them? Here is the critical piece of the puzzle that almost the entire market missed. ASTS didn't simply take that $1 billion and leave existing shareholders totally exposed to dilution. Instead, they strategically carved out $96.9 million of those proceeds to purchase something called capped calls. Think of this as an aggressive dilution shield. It functions as a financial insurance policy that strictly limits actual shareholder equity dilution all the way up to an effective share price of $149.20. Let that sink in. That's a staggering 125% premium to where the stock was trading before the announcement. In plain English, ASTS secured a full $1 billion of vital, cheap capital at a rock-bottom 1.625% interest rate to fund their orbital access and satellite deployment, all without meaningfully sacrificing near-term equity value. So the very move that spooked investors was actually one of the most shareholder-friendly ways to raise this kind of money. And here's where the story starts to get genuinely complicated, because there are fundamental catalysts quietly brewing that the market is entirely ignoring. Under the surface of all this selling, the operational milestones are actually right on track. BlueBird 11 has successfully arrived at Cape Canaveral, setting the stage for a critical August launch of satellites 11 through 13. But the most intriguing detail of all was buried deep in the fine print of their recent 8K filing. Management included very specific language suggesting the new debt proceeds could be used for acquisitions to vertically integrate their business. So what does that actually mean? Analysts are now actively speculating that ASTS might be gearing up to outright acquire a rocket company. Just imagine that for a second. If they pull that off, they drastically reduce their reliance on expensive third-party launch providers, controlling their own destiny in orbit. Could a company this beaten down really be quietly plotting a move that ambitious? That all sounds impressive, sure, but what's really happening underneath the hood when we pop it open and examine the technical indicators? Right now, the stock is trapped in a deeply entrenched bearish regime, trading steeply below its 20-day, 50-day, and 200-day moving averages. The average true range, or ATR, is elevated at nearly $7, which tells us we're seeing massive intraday price swings and extreme volatility. The MACD remains firmly negative. So far, so ugly. However, and this is a big however, the daily Relative Strength Index, or RSI, is sitting right at 38.25. What does that number tell us? It means the stock is rapidly approaching deep oversold territory, and the relentless selling pressure is mathematically beginning to exhaust itself. The sellers, in other words, may be running out of ammunition. And that brings us straight to the one dynamic that investors truly care about. What happens when short sellers suddenly get trapped? AST SpaceMobile is currently sitting on a staggering amount of fuel for a potential short squeeze. Short interest sits at 21.08% of the entire public float, meaning over 64.7 million shares are currently sold short. But it gets even more volatile when we crack open the options chain. The market is pricing in binary, extreme volatility, with near-term implied volatility hovering above 112%. And here's the really explosive part. There are massive gamma magnets sitting on the call side. We're seeing incredibly heavy open interest stacked at the $60, $70, and $75 strike prices. So what happens if momentum shifts even slightly upward? The market makers who sold all those calls would be forced to rush in and buy the underlying stock to hedge their risk, which could violently yank the price higher. Picture that chain reaction. A small spark on a float this heavily shorted could turn into a genuine firestorm. At first glance, this looks like a textbook setup for a massive short covering rally. But there's one underlying factor that makes that clean conclusion much harder to defend. When we track the actual money flow, we uncover a glaring, massive divergence. On one hand, institutional accumulation is incredibly robust. Institutions now own nearly 61% of the entire company, with $2.34 billion in buying over the last 12 months, vastly outpacing the $487 million in selling. Heavy hitters like BlackRock and State Street have been aggressively piling in, adding millions of shares. But then we hit the major red flag, because at the exact same time, insiders are aggressively dumping the stock. Over the past 6 months, company insiders have executed 7 major sale transactions and, remarkably, 0 purchases. The CEO alone recently unloaded over 3 million shares for $270.8 million. So how do you reconcile that? The smartest institutional money on the planet is buying with both hands, while the people who run the company are heading for the exits. That contradiction leads us directly into the one question every investor actually cares about. What is this company genuinely worth? Despite the recent crash down to the $57 level, the consensus 12-month price target remains heavily elevated, sitting between $85 and $86.95. We've recently watched B. Riley upgrade the stock to a buy, and even more notably, Piper Sandler initiated fresh coverage with an overweight rating and a massive $100 price target. Even Deutsche Bank, who recently downgraded the stock all the way to a hold, still kept their price target parked at $106. Think about what that means. It creates an enormous upside gap between where the stock is trading today and where the analysts collectively see fair value sitting. And that gap leads us directly into how we can actually approach trading this deeply polarized setup. Because of the deeply oversold technicals, that massive 21% short float, and the widely misunderstood dilution shield, conditions appear perfectly primed for a sharp short covering rally. For a short-term long-only trade setup between July 19th and July 25th, the optimal entry zone sits between $54 and $56.50. The play here is to scale in patiently near that recent panic low. The first upside resistance target is the daily pivot at $63.81. If price breaks cleanly through that, the second target becomes the pre-flush breakdown level at $66.50. And the final target is the major psychological magnet at $70, right where all that heavy call open interest is stacked up waiting. But make no mistake, disciplined risk management here is absolutely non-negotiable. A daily close below the structural support at $49.50 fully invalidates this entire setup. And at that point, you simply have to cut the loss and walk away. Still, before you get too bullish on a quick technical bounce, there's yet another layer to this. And it's the long-term survival story that ultimately decides everything. To survive and thrive over the long haul, AST SpaceMobile must execute flawlessly on its upcoming launch cadence. They are strictly scheduled to launch BlueBirds 11 through 13 in August, with an ambitious goal of deploying 45 satellites by early 2027. And here's the harsh truth. Any further delays will absolutely decimate what's left of institutional patience. But the ultimate reality check comes down to their cash burn. They boast a massive total addressable market with $1.2 billion in signed agreements. which sounds phenomenal. Yet their first quarter 2026 revenue was a mere $14.73 million against deep net losses. So the entire question becomes this: can they translate those signed agreements into recognized commercial revenue before this brand new $1 billion capital runway evaporates beneath them? That's the tightrope they're walking. Now, before we wrap this up, a quick and important word. Everything I've shared with you today is for educational and informational purposes only. I am not a financial advisor, and nothing in this video should be taken as personalized financial or investment advice. Every trade and investment carries real risk, including the potential loss of your capital. Please always do your own thorough research and consider speaking with a licensed financial professional before making any investment decisions. So when we pull it all together, ASTS reveals itself as a high beta, high stakes battleground stock. It is entirely unsuited for risk-averse portfolios, full stop. But for those investors with a genuinely high risk tolerance, this 60% drawdown, combined with a heavily shorted float and a deeply misunderstood capital raise, arguably offers one of the most compelling entry points we've seen in this name all year. Now I want to hear from you. If AST SpaceMobile really does use that debt to acquire its own rocket company, do you think it becomes the next dominant force in space? Or is this all just a high-risk gamble that ends in tears? Drop your honest take in the comments below. I read every single one. And if this breakdown helped you see past the panic, please smash that like button and subscribe so you never miss the next deep dive. Thanks so much for watching, and I'll catch you in the next one.